Picture this. You wake up, check your portfolio, and realize that an asset you own has just, well, vaporized. A quarter of its value, gone in an instant. That's exactly the shock that hit the precious metals market, sending a huge wave of panic through investors. We're talking about a drop of as much as 24% for some popular silver ETFs. In a single day. I mean, that's a staggering number, almost hard to believe. So, on January 22nd, 2026, you had tons of regular investors just staring at their screens, completely stunned. Gold and silver ETFs, those funds on the stock market that are supposed to mirror the price of the actual metal, were in an absolute freefall. The question on everyone's mind was simple. What in the world just happened? So, was this the start of a massive bust for precious metals, or was there something else going on under the surface? In this explainer, we're going to dig in, follow the clues, and figure out the real story behind this crazy event. All right, let's get into it. First things first, let's just get a handle on the scale of this thing. Just how bad was the damage really? Well, it was pretty bad. The Tata Silver ETF took a 24% nosedive during the day. The very popular Silver Bees ETF ended down 11%. And hey, it wasn't just silver. Gold ETFs got hammered too, some falling by as much as 15%. This was no small dip. This was a major market-shaking moment. Now, whenever there's confusion and panic, you know what comes next, right? Rumors. A popular theory started spreading like wildfire online, trying to explain the chaos. The only problem? The data didn't add up. A lot of people were quick to point fingers at political news coming out of the US. But as we're about to see, that was a classic mix-up of correlation and causation. The real reason was hiding in plain sight, right inside the mechanics of the market itself. And this is where the story gets really interesting. Because to find the truth, all we have to do is make one simple comparison: the price of the ETF versus the price of the actual metal it's supposed to represent. Okay, here it is, the smoking gun. On the very same day that the silver ETFs closed down a whopping 11%, the price of actual physical silver on India's MCX exchange went up by 2.76%. Wait, what? An ETF is crashing while the thing it's based on is rising? That just doesn't make any sense unless something else is going on. And this chart really just spells it out perfectly, doesn't it? It shows this complete and total disconnect. You've got two things that are supposed to move together, literally heading in opposite directions. That tells you, right off the bat, the problem wasn't with silver. The problem was with the ETF. And it gets even stranger, because this wasn't just a local thing. If you look at the global markets, international silver prices were up 3.3% that day, and gold was up over 2%. So the entire world is saying precious metals are having a great day, but these specific Indian ETFs were just getting crushed. The plot thickens. You see, to understand the crash, we have to understand the bubble that came right before it. Because this plunge didn't happen in a vacuum. It was the predictable end to a period of some really intense speculation. So let's just rewind the clock 2 weeks. Between January 9th and the 21st, international silver prices had a really nice run, up 21%. But look at the silver ETF in India during that exact same time. It shot up an insane 39%. The ETF's price had totally broken away from reality, creating this massive artificial premium. So what was fueling this frenzy? It was all about a rumor, a really big rumor that the Indian government was about to jack up the import duty on precious metals from 6% all the way to 15% in the next budget. See, the price of gold and silver in India is always a little bit higher than the global price because of these import taxes. Traders were betting that this price gap was about to get much, much wider, so they piled into the ETFs, hoping to cash in on that expected price hike, and in the process, they pushed the ETF prices way, way above their true value. And then, the bubble popped. As soon as the market figured out that the big duty hike wasn't going to happen, all of that speculative hot air that had inflated the ETF just vanished. Almost overnight, the price came crashing back down to earth. And that brings us to the most important point of all. This wasn't a crash in the fundamental value of gold or silver. It was a fast, brutal, but ultimately necessary price correction in a very specific financial product. This is literally the textbook definition of a market correction. The ETF's price got totally out of whack because of speculation, and this big drop was just the market's way of slamming it back into alignment with its real-world value. And you don't have to take my word for it. Market experts saw the same thing.
As Anand Rathi put it, this wasn't a bearish sign for the metals at all. It was just the market fixing a pricing error in the ETFs. Simple as that.
So, what's the big lesson here for all of us as investors? Well, this whole episode is a fantastic reminder of the difference between an asset and the specific product you use to invest in it.
So what does all this mean for you? Well, the number one thing to remember is that the fundamental reasons for owning gold and silver haven't changed one bit. If you zoom out, central banks are still buying gold like crazy. Industrial demand for silver for things like AI and electric cars is incredibly strong. This whole drama was just a weird technical issue, a lesson in how the plumbing of an investment product can get clogged up sometimes.
And this is exactly why this kind of portfolio breakdown is so important. Even with a strong outlook, precious metals can be volatile. Experts almost always recommend they only make up a small strategic piece of your portfolio. Think 5 to 10%. It's there for balance, as a hedge, not for wild speculation. This event is a perfect reminder of why that discipline matters so much. Which brings us right back to where we started. For anyone who got caught up in that speculative hype, this fall probably felt like a painful trap. But for investors who understood the real story, who knew the fundamentals were still solid, it was a rare correction, a momentary chance to buy a great asset at a discount, all thanks to the market's own temporary madness.